Hi everyone, it's your Bald Indian here, and in this video I'm going to talk through 4 main things you should consider before investing in ETF, and I will also give you a list of ETFs by categories that wealthy investors put their money in. Okay, so here are 4 things you should look at before investing in ETF that not everyone is talking about. Number 1, expense ratio. An expense ratio is a cost of owning a mutual fund or an ETF. As per Investopedia, it is a measure of what percentage of a fund's total assets are required to cover various operating expenses each year. Think of expense ratio as a management fee paid to the fund companies for the benefit of owning the fund. Typically, ETF expense ratio are less than 1%. That means for every $1,000 you invest, you'll pay less than $10 a year in expenses. These fees are mostly invisible to the investors as they are charged on the back end and are included in the ETF stock price itself. You can find the expense ratio of particular ETF by just a simple Google search with the name of that ETF. As you can see here, as ETFs are passively managed, they have a lower expense ratio compared to mutual funds. A good expense ratio is around 0.5 to 0.75% as an actively managed portfolio. An expense ratio greater than 1% is actually considered really high. In the last decade, it has been observed that the ETF fees have dropped 40%, particularly in the US compared to Europe, Asia, and Canada, as per the study conducted by one of the major banks in the US itself. According to the same report, asset managers like Vanguard have been cutting their fees to their various ETF products. For Vanguard in particular, it slashed fee across 21 of its largest ETFs, all with around $660 billion under management. As a result, this price cut will save investors in the region of $88 million in fees every single year. It's recommended that you should prioritize investing in ETF with a competitive and stable expense ratio. Alright, before moving to the next point, you know what is another thing that literally has no fees? It's dropping a like on this video and subscribing to my channel. It's totally free. Come on everyone, you gotta do it. Thank you. This really helps the YouTube algorithm to recommend this video. Alright, moving on. The next thing you should look at before investing in the ETF is liquidity. One of the major factors in an ETF or a stock or anything else that is traded publicly is liquidity. Liquidity of stock generally refers to how fast shares of stocks can be bought or sold without substantially impacting the stock price itself. For example, let's consider there is a person who wants to buy a PS5 worth $500 but doesn't have $500 in cash. Instead, he would like to exchange that for an antique lamp that has been appraised for $500. Well, in this case, as there are not a lot of people who are looking to buy an antique lamp in exchange for a PS5, it is going to be a challenge, which means there is no market liquidity. Instead, if the person had cash on hand, which is the most liquid asset, as everyone wants and accepts cash, it would have been easier to buy an PS5. In a similar way, it is important for a stock to be liquid in order to get in and out of a trade. You can determine the stock liquidity by looking at the stock's bid price, which is the price buyer offers per share, and asking price, which is the price the seller is willing to accept. When the spread between bid and ask price grows, the markets become more illiquid, and when the bid ask spread is tight, that means stock is liquid. For example, as you can see, the bid-ask spread for GameStop is $3 versus just 4 cents for Apple. Similarly, there are various factors that can affect the liquidity of the ETF, which can be trading volume of the stock within the ETF and the trading volume of the ETF itself. Okay, the next thing you should factor in while buying the ETF is leveraged ETFs. As per Investopedia, a leveraged exchange-traded fund is a marketable security that uses financial derivatives and debt to amplify the return of an underlying index itself. This means comparing to the traditional ETF, which are basket of stocks, leveraged ETF, which are based on derivatives like option contract, move 2 to 3 times the stock value, where traditional ETF move one-on-one basis. For example, let's take a look at TQQQ, which is a leveraged ETF based on Nasdaq 100 index, which holds stocks like Apple, Microsoft, Amazon, Tesla, Google, Facebook, Nvidia, PayPal, etc. Mostly top 100 tech companies. So when NQ goes up by 1%, TQQQ will be up by 3%. As you can see in this chart, so far in 2021, NQ is up 21.98%, whereas TQQQ is up a whopping 73.84%. That being said, leverage ETFs are very risky as they are based on option contracts. And if you're not aware of terms like time decay, volatility, you should probably stay away from them. Also, leverage ETFs generally have a high expense ratio of an about 0.95% compared to an average of 0.2% for traditional ETFs. Okay, so next we are going to take a look at tax implications for ETFs. ETFs are generally considered as tax efficient due to their unique structure. That is, if assets in ETFs go up in value and the fund manager decide to sell it, then it will create a capital gain. And by law, funds must pay this capital gains to the shareholders, which is you guys. And you pay the taxes on this capital gain. But because of creation and redemption magic, most of ETF don't pay capital gains taxes at all. I did upload a video where I talked through the ETF creation and redemption process. You can check it by clicking on the I button in the right corner, or I will also link it in the description below. So because of this unique ETF structure, you only pay taxes on capital gains from your ETF when you sell them. Okay, even though ETFs are tax efficient, any dividends and interest payments from those ETFs are taxed similarly to income from underlying stock inside them. And this income needs to be reported on your 1099 statement that you will receive from your brokerage like Robinhood, Public or TD Ameritrade. Also, you can take advantage of long-term capital gains if you did hold the ETFs for more than a year, and you should consider selling those ETFs with losses before holding it for 1 year to take advantage of short-term capital losses. But please do check with your CPA, as you should not trust a guy talking to his camera on internet. So these were the 4 main things, if not all, you should consider before investing in ETF. And here is the list of ETFs if you're looking to have a exposure to broader markets. Within technology category, here are top 5 ETFs. VGT, it's Vanguard Information Technology ETF, trading at $436 and is up by at least 25% in 2021. They pay out dividend of 89 cents every quarter. They have 54.4 billion total assets with major holdings in Apple, Microsoft, Nvidia, Visa, Adobe, Mastercard, Salesforce, and PayPal, and many more. They have a really good expense ratio of 0.10%. Next, we have XLK, which is Technology Select Sector Spider Fund, trading at $165 and is up by 29% in 2021. They pay out dividend of 27 cents every quarter. They have 49.77 billion total assets with major holdings in Apple, Microsoft, Nvidia, Visa, Adobe, Mastercard, Salesforce, and Cisco. They have a really good expense ratio of 0.12%. Next, we have RYT, which is Invesco S&P 500 Equal Weighted Technology ETF. It's currently trading at $308 and is up by 23% in 2021 so far. They pay out dividend of 37 cents every quarter. They have $2.82 billion asset under management with major holdings in Enphase, AMD, Nvidia, HP, Seagate, Qualcomm, and Teradyne. They have an expense ratio of 0.4%, which is slightly on the higher side. As we were hit by pandemic, health was one of the outperforming sector, and these are some of the ETFs that you should look at. VHT, Vanguard Healthcare ETF. The current stock price is $247. And it's up by 11% this year, and it's almost up by 30% since January of last year. They pay out dividend of 89 cents every quarter. They have $16.36 billion assets under management. They have major holdings in United Health Group, Johnson & Johnson, Pfizer, Merck & Co. They have an expense ratio of 0.10%, which is pretty good. Next, we have XLV, which is Healthcare Select Sector Spider ETF. The current stock price is at $130.37. which is up by 15.42% this year alone. They pay out dividend of 27 cents every quarter. They have $31.86 billion assets under management, and their major holdings are United Health Group, Johnson & Johnson, Pfizer, Merck & Co. The expense ratio for this ETF is 0.12%. Okay, moving on to the consumer discretionary ETFs. We have XLY. It's Consumer Discretionary Select Sector Spider ETF. It's trading at $199.65. The stock is up almost 25% year to date. They have $23.69 billion assets under management with holdings in Amazon, Tesla, Home Depot, McDonald's, Nike, Lowe's, Starbucks, and Target. They have an expense ratio of 0.05%, which is pretty amazing. And here are 3 total stock market ETF if you want to cast a wider net with your investments. VTI. It's Vanguard Total Stock Market ETF. It's currently trading at $230.16, and it's up almost 21.25% year to date. They pay out dividend of 72 cents every quarter. They have 285 billion asset under management with major holdings in Microsoft, Apple, Amazon, Alphabet, Facebook, or you can call it Meta, Nvidia, JP Morgan, Berkshire Hathaway, and so on. They have an expense ratio of 0.03%, which is pretty low. Next we have VEA. It's Vanguard FTSE Developed Market ETF. It's currently trading at $49.88 and is up by around 7% this year. They pay out dividend of 20 cents every quarter. They have $105.25 billion asset under management with major holdings in Rogers and Spotify. They have an expense ratio of 0.05%. Next we have VOO. Vanguard S&P 500 ETF trading at $416.84 and it is up by 23.45% this year. They pay out dividend of $1.31 every quarter. They have $267.32 billion assets under management with major holdings in Microsoft, Apple, Amazon, Tesla, Alphabet, Meta, Nvidia. They have an expense ratio of 0.03%. So these were some best ETF to look at by category as well as things to look before you invest in ETF itself. Before I end this video, I would like to tell you that I'm not a financial advisor and I do not recommend you to invest your hard-earned money in this ETF. Please do your own due diligence in investing in these ETFs or anything of that matter by reading and researching. I'll make sure to link websites I use for my research in the description below. Please do like the video and subscribe to my channel if I provided any value to you today. And you can check out my videos around personal finance by clicking here. But that's it for now, and until next time, peace.